Today's investment term is stock-based compensation, or short form stock-based comp. So what stock-based compensation means, it typically are certain employer issue certain stock to employee as an incentive for those employees to really align their interest with these companies. So what are actually some form of stock-based compensation? For example, they can issue employees some option, meaning they can buy certain you can buy certain shares at a certain strike price, or they can just issue certain restricted stock unit, and they typically go with certain vest schedule, and there's a certain tax implication with these offerings. So why employees do that? So one part is, as I said, try to align interest. The second one is, especially for tech form at a very early stage, employer doesn't really have so much cash. So to show they're generous enough, and then they typically give a lot of stock option, and then to extend out the total package to employee in order to attract the really talent to work for them. However, to accounting world, there's good and bad for stock-based compensation. So one part is stock-based compensation treated as expense, so it does show on the P&L statement. But a lot of companies actually, besides report this GAAP compliant net profit and net loss, they also report this adjusted EBITDA. So when they report that, they actually add back those stock-based compensation to really result a bigger EBITDA, adjusted EBITDA. And that actually, they say that's an indication of their cash flow generation capability. However, that's actually not good for the common shareholder, because you issue a lot of stock that actually dilute the whole stock pools. So only when the company really use this approach to increase everyone's morale and really have align everyone's interest in order to have the whole company value increased, that actually could result in the common shareholders' interest increase.